So good morning, guys. Today we'll be talking about the psychology of a trend market. The psychology of a trend market. You can call it the methodology of a trend market. Anyone you want to call it, but I want to call it the psychology of a trend market. Whenever the market trends, that is the best time to start taking our trade. Remember, in our last class, based on the market phase, we have the accumulation, distribution, the markup phase, and the markdown phase. Now the trending phase is where you want to actually enter a trade. And if you look at my chart, I am currently looking at the monthly chart. I'm supposed to go down from 1 minute down to the daily, to the weekly, but I want us to understand the perspective from the higher time frame. The same perspective you use from the higher time frame is the same thing you are going to use for the lower time frame. So very quickly, what we'll be looking for here, the important key levels in this important aspect in the psychology of a trend market is the time frame analysis. The time frame analysis, that's the first one. Then the second, the time frame analysis is the first. Sorry. The time frame analysis is the first thing you want to look out for. The second thing is the candle bars. Then the next thing is your key level areas. Your key level areas. Then you want to watch out for what? Your divergence. And of course, you know what does divergence signifies? For a what? A reversal to end the trade. A reversal to end the trade. Now we're picking all this one by one. Now the first is the time frame analysis. The time frame analysis. The time frame analysis. The time frame analysis, like I said, it's the time that it takes your particular trade to start and end. You have to understand the right time frame where the market is currently happening, and that is why we are treating time frame analysis. Now looking at this chart, we are having our monthly chart. Let me take it to the weekly. Now we already understand that the main time frame here is the monthly because of what? It has been trending. Can you see? It has been trending for how many months? And so let's assume that we saw this particular trade at this junction here. This is the test of the moving average. This is the level where we saw the trade, and we want to keep on buying this trade until we spot a reversal, like a trend trading system. The time frame, now we already know that the time frame analysis, the main time frame here is the what? Is the monthly time frame. So what are we going to do? Now we saw the reaccumulation, then we have our breakout at this level. Price breaks out from this level. We have our breakout from this level. Can you see this bar? This is our breakout bar. This one up here is our breakout bar. Now what happened? We want to start buying the trend, the golden market. We want to start buying gold. Now we entered from this zone. I will tell you why we entered from here when we get to our entry areas. When we get to our entry areas, you understand. Now let's assume we enter from here. Now we already know that the main time frame is the monthly. So with that, we want to see our what? Our divergence from the monthly time frame. I want to see a break in market structure from the monthly time frame. I hope you understand that. Now let's continue. If you don't understand, kindly watch our video, the previous video we talked about based on how to confirm divergence and the break of market structures. Now, we want to see a break in market structure. We want to see a divergence for price to reverse. Now, if we are not looking for a reversal, we are actually going to be looking for a continuation of trend. And in that, so we are actually looking for price retracement to our key level areas. Our key level areas. Now, if you look at it, price retraced down to this other block here and went higher. Now, I want to explain one important feature, one important thing you have to understand in trend trading. Let me increase the so you can see the body of the candle. We're good. Now, can you see this candle? This one, 1, 2, 3. I want to talk about these candles, these 3 candles. I will name them A, candle A, B, and candle C. Now listen and listen very good. Listen and listen very good. Whenever you are trading a trend trading signal, it is best for you to wait for the close of the main time frame bar. It is best for you to wait for the close of the main time frame bar. For example, if you have a monthly breakout and you want to trade based on the monthly, you are advised to wait for the end of the month in order for you to close that trade, because you took your entry from the monthly time frame. Why did I say so? I'm saying that simply because in as much as we have this A closes bullish, then automatically we are supposed to see B closes bullish. We are supposed to see C closes bullish. Price will continue to close bullish. It can even take 8 weeks. Let's look for a better example. A better example where price took a lot. Look at this. It took 1, 2, 3, 4, 5. 5 months for it to form another bearish bar. So what am I trying to say? In as much as the monthly bar closes bullish, that means your main time frame closes bullish, you are not to turn your bias against that trend. For example, you spot a divergence on the weekly time frame, you spot a divergence on the daily, you spot divergence on the 4 hours, and because of you spot the divergence from that lower time frame, you are using it to judge the higher time frame divergence. No, it does not work that way. It doesn't work that way at all. You are supposed to do what? You are supposed to use it to judge the current, as in, if it's 4 hours, you are supposed to know you are holding the trade for a week. If it is daily, you are holding the trade for a month. So if it is a monthly, when you see a monthly closes bullish, don't expect price to close bearish. Take it out of your mind. Still maintain your bullish trend trading bias. Look at this. At this point in time, I'm very sure we have a daily time frame divergence. But what happened? The next bar closes bullish, and the next bar also closes bullish. So this bar you are seeing here, ABC, will always occur, in the sense that in order for price to turn into a reversal pattern, price will form a divergence, break of market structure on the main time frame. But in as long as these two has not occurred, the price tends to always be what? Bullish. For example, if I see 1, 2, 3 bullish bar, I'll be expecting price to be bullish the next month, because there is no sign of reversal. So what I'll be expecting here is what? To go into the market bullish. That is what I'll be expecting, nothing again. So guys, you need to understand this. When you have A, B, C, D, 5, 4, 6, 7, 8 bars that are bullish in a bullish market, don't assume the next day will be bearish. The next month will be bearish. Why? Because you are seeing a sign of divergence from the lower time frame, or you are seeing a retracement sign. No, still maintain your bullish bias. When we get to the psychology of the retracement market, I will explain to you why I don't like trading the retracement. It hurts me a lot. I will explain to you very well. So you have to focus on getting into the trend of that particular pair. The trend is what you want to take the trade from. The trend. Now, going further, having said that, the next thing we are going to talk about now is what? Good. The candle bars. I just explained the candle bars now. To summarize these candle bars, your main time frame, in as long as you are bullish and your main time frame closes bullish at the end of the month, you are not supposed to look for a bearish bias on that bar. You are supposed to look for your bullish trend. Joining the trend. Don't assume because you are seeing a divergence or you are seeing a retracement chart patterns, or you are having this trend that the market will retrace, then you want to trade the retracement. It's good when you are on the right side, but it is always best to maintain a what? A bullish bias. Another thing on the candle bar, before any retracement will happen, listen to this rule, there must be an opposition bar that will either form another block or is going to form what I call the John the Baptist bar. Why do I call it the John the Baptist bar? Because John the Baptist happens to be the forerunner of Jesus Christ, right? So he came to announce the coming of Christ. So the other block you are seeing, or the John the Baptist bar I called it, is telling you, is announcing to you the retracement or the reversal that is coming. This is the second thing you have to understand when trading the trend. Now, how can we interpret this? Now let's start. I'll start from this low. Now see, before we have this particular drop here, what happened? We saw what happens to be a John the Baptist bar. This is the bar, and this bar resulted to what? This deep retracement. If you look at this happens to be shallow, sideways, and it gave us a deep retracement. There will always be an announcement bar, opposition bar, that will announce to you the deep retracement. This is the other one. Can you see this? This gave us this deep retracement. Are you seeing this? We'll continue again. This isn't that deep. It is just sideways. This is a sideways market, not deep. So what happened? We have another what? Other block. Price went higher. This block here is telling you that price is coming set to what? To deep. And we have another one here. Another what? Notification. Okay, we have passed this. Expect another dip in price. And what happened there? Price dips. Do you get this? There is always an announcement bar before the main. There's always an announcement bar before the main dip in price. It will come before the main dip in price. There will always be an announcement bar. Now, what is the next thing you are going to see here? Price came out from this range, went higher, form another order block here, or a John the Baptist bar here. This, and what did you see? You are seeing a deep retracement. This is it. Can you see? Price went higher again. This, of course, you know these bar of blocks are in the range of this particular rectangle, so we are not taking them. Now, what happened? This is just a sideways market telling you that, okay, get set. Another one coming, get set. This and that one, get set. There will always be an announcement of the what? Coming retracement. Get set. And what do we have here? We have another what? A full dip. And eventually this dip gave us what? this dip gave us what? Price retracement, deeper ones, a drop. Now we take it again to the bearish side. Remember, we are talking about the candle bars. Look at the announcement bar, and what happened? We have the deep retracement. Can you see? This is another one. Announcement bars, and what do we have here? We have the retracement coming in, and price went higher. Here again, this is where we have our breakout from this particular bar. This is where we have our breakout. Now, even inside the range, look at it. We have the announcement bar, and we have what? A drop, a dip. Can you see? We have another announcement bar here. We have another announcement bar here. And what do we have? We have another dip. You can see. And what happened? There will always be an announcement bar before a deep retracement. That is what you need to understand. This is a dip. A range. This also look like a range. Yeah, this is a range. Also look like a range. And what do we have here now? We have a bigger dip. So what am I trying to say? There will always be an announcement bar, like an order block or a what? Or a John the Baptist bar before we have what? A retracement, a deep retracement. Now, if that deep retracement does not break our market structure, our key level areas, we still continue to trend. Now, that brings us to our next concept in the psychology of a trending market. The next thing is the key level areas. Of course, you know the key level areas. What is just it? Simple, clear, and be clear for you. In as much our retracement do not break the market structure region, we are still on that trend. This is it. This is our market structure region here. And let me turn them to yellow. This is our market structure region here. Another market structure region here. Price did not break it. Can you see? And that market structure region here, price did not break it. And that market structure region here, price did not break it. And so that's why we keep on having it until we have a break in the structure and you saw price move down. Now this is it. This is it. When you see the accumulation comes in, market accumulates from this zone, it will continue to follow this rule. It will form the candle bars, form the deep retracement, form another candle bars. When I mean the candle bars, the John the Baptist bar or the other block, form a deep retracement, form another candle bar, another candle bar, another candle bar, form a deep retracement, while respecting the key level areas, which is the market structure, the moving average levels, and the other block. And what happened? A break and a divergence will give us what? A breakout, a reversal trade. And the same thing occur here. We have the drop, market drops after we have the break in market structure and did what? Move higher. Let me add a divergence indicator, MACD. Now, can you see the divergence here? We have a divergence here. We have a divergence here. Market diverge to the upside. We have a pure breakout here. This was the breakout of this total accumulation. And price started what? Respecting the market structure. Started respecting market structure. Still following the same principle. So guys, don't forget the candle bars. There will be another block or a John the Baptist bar to announce the coming of the retracement, a deeper retracement. The same thing happens to key level areas. It will announce the coming of a deeper retracement. The same thing happens to divergence reversal. So after the deeper retracement, if the deeper retracement results to a divergence and a reversal, that means a break in the market structure of the key level areas, we have a what? A change in trend, and the market still continues that way. This is the psychology of a trend market. Thank you.